Simon Rose from the campaign group SaveOurSavers. You work to represent the views of savers, essentially. So not happy with another 3 years of record low rates?
No, unfortunately not. As we've been hearing, it's been savers and pensioners who've sort of borne the brunt of what's gone on for the last few years. And the idea that we might be getting another 3 years of being unable to preserve the value of your savings is quite appalling. And in fact, not just savers and pensioners, but most people now are finding that because wages are fairly stagnant, that inflation is becoming that much more important. In the past, sometimes wages would keep pace with inflation, but they aren't doing so now. And the idea that the Bank of England, which is obliged, as the governor said, to keep to a target of 2%, the idea that it can just decide to ignore this and instead produce what seems like its own target of 2.5%, is quite extraordinary. I was very surprised to hear the Chancellor not even refer to that, saying as far as he's concerned, he's happy if house prices go up and if people want to borrow more. Well, we're in this mess because we borrowed too much, and the solution seems to be let's keep interest rates low and just borrow a bit more in the hope that somehow what hasn't worked for the last 4 years will work in the next 3.
But Simon, what they're doing is they're making a calculation that if you keep borrowing rates low, you will create jobs. And if you create jobs, you create wealth in the whole of the rest of the economy. You may not agree with that, but that is a pretty, it's quite convincing in some ways.
Well, convincing in some ways, except we've had 4 years of this, and for many people, borrowing rates are no lower. If you're taking out money on a credit card, if you're trying to get an overdraft from your bank, then the rate is still pretty much the same as it was before the crisis happened. The only real low borrowing rate is for mortgages. So as was mentioned at the press conference today, do we not think this is going to produce a further surge in house prices? You're already being boosted by the Help to Buy policy. This could be very, very dangerous indeed.
So you'd raise interest rates, would you? Would you raise interest rates?
Yes,
then?
I think suppressing interest rates, deciding that you can determine the price of money, which is effectively what interest rates is, as we've heard, the BBC's done programmes on this, what it's producing is a zombie economy. It's not doing anything to cure the patient. It's a form of pain relief. Well, the patient has not been cured, but now he's become addicted to this pain relief, such that any small increase in interest rates would now be quite extraordinarily difficult in a way that it would not have been several years ago. So I'm afraid I don't think that until we actually get back to more normalized rates, we can expect to see proper sustained growth. To expect the growth in the economy to dependent upon cheap money is simply putting more problems in our path for the future.
Dominic, you mentioned the housing market. We've got a few texts here on this subject mentioning houses and house prices. Mm-hmm. The house price increases are in the southeast. Why not increased rates there and not in the lower paid areas? Not really an option?
You can't have regional interest rates within a currency union. The Eurozone mess has told us that. So you can't, the sterling area, which is the UK, you can't have different interest rates for different parts of it, unfortunately.
Tony in Newcastle says Mr. Carney created a housing bubble in Canada. You talked an hour ago about less than 2 years into a similar process in Canada. What happened?
Well, he raised rates. So it didn't last long in Canada. Canada has... You could argue that low interest rates in Canada have increased housing prices. They also have a slightly different economy to ours because they have huge amounts of natural resources that we don't have. They were one of those economies that actually did much less badly in the financial crisis than we did. There are more than one reason why Canada might be having a boom, but yes, low rates might be one of them.
And Simon Rose, just a thought here from Steve in Greenwich. He says, I have large savings, earning virtually no money. I'm going to buy a house to let out, my only option to get a return. It'll lead to house price inflation and others locked out of the market, but what else can I do? Is that the kind of thing you hear from your members quite a lot?
Yes, the problem is that if you can't get a return on your money in cash savings with a very low risk, then people are inclined to start taking on more risk. And that, of course, is ultimately very dangerous indeed. If you can't preserve the value of your money in cash savings, then you've got to find somewhere else to go. And
you just invest. Sorry to interrupt. That's kind of what the Bank of England wants us to do, doesn't it? Is not to save, to invest in an asset like a house or a company or something like that.
The growth in the economy comes from small and medium-sized businesses who, despite the support from government and funding for lending, have been finding it incredibly hard to get money. The reason is because we are disincentivizing saving through low interest rates. Now, the Chancellor himself, when in opposition, said that to actually favour borrowing at the expense of saving is economically illiterate and morally reprehensible. Yet that is exactly what they're doing. You will only get a strong economy that is growing organically if you incentivise savings, because it is savings that provides the investment funds that businesses need.
Thank you very much, Simon. Simon Rose from the campaign group Save Our Savers.